Hey, good morning, everyone. Sean here. Thank you for joining us for our financial projections webinar. Very excited to be here with you today to share with you a little bit about how we approach financial projections for both startup as well as existing businesses. For those of you who don't know much about the SBDC, I always like to start out with sharing a little bit about who we are and what we do. And in a nutshell, the SBDC is a partnership between the University of Verne and the Small Business Administration with a very simple mission, and that's to help business owners just like you either get started or grow. And we do this two ways, and we're looking at our homepage on our website. We do it through trainings, and we host a lot of workshops and webinars ourselves, but we also try to market other local events that we feel are really relevant to businesses. And then we support the workshops with one-on-one consulting. And you can click here on our website to apply now. What we basically do is ask you a few short questions about your business. And what we can do then is set up a time where we can sit down and talk to you about your business and how we can help. But today, I want to point out on our resources page of our website, we have a lot of great resources that we try to use in the consulting to make available to businesses throughout the year, no day or night. Now today I want to get into the subject at hand, which is financial projections. But everybody's going to be on mute as part of this webinar. And at the end, we'll have time for questions, but we want you to chat in your questions as we go. And we will definitely have time set aside afterwards to address them. And we'll also talk to you a little bit about signing up and how it works. So to get right into it, I have if you go to our homepage at lavernesbdc.org and you click on resources, we have under business planning, we have our financial projections template that we're going to be working from today. And well, what I like most about this projections template is it has a step-by-step guide that in essence will walk you through what I'm going to do here today, but more in written form. So you have a supplemental guide to refer back to it. And as I open up the spreadsheet, I just want to point out kind of how, well, you see here you have directions, starting point, payroll, kind of tabs, if you will. And as this guy opens up in Excel, you have directions, starting point, payroll. So you can see how they kind of talk to each other and work together. But if we're looking at the projections, I use these for both existing as well as startup businesses to help in the consulting process. For the startup businesses, it helps answer a lot of questions like, is my business feasible? How much should I pay myself? How much can I afford to spend on marketing? Things of that nature, really thinking through the business and its profitability. And, you're investing your time and your money into this. What's the potential return? For existing businesses, in addition to just good budgeting, I often use this to help put together loan packages. Even if you're a profitable business and you're looking to expand and you can cash flow the loan based on your last year's tax returns, which is good, the bank will likely ask you, three main questions. How much do you need? What are you going to use my money for? And how am I going to get paid back? And then even if you're profitable, they may ask you for some projections. And so just to show, you have a plan for their money. It's always a good thing. And let's get into it. So today I've opened up the spreadsheet from our website, and I'm going to go ahead and click on Enable Editing so that I can kind of go through this. And we're going to use just a fictitious example of a Taekwondo studio. My son is doing Taekwondo, studying to do his black belt. And so I thought, I've never actually worked with a Taekwondo studio, but we can use it as an example to have a little fun. So I'm going to put in here my name we're on the directions tab. Let's call it Sean's TKD, right, for Taekwondo. I always like to start with the calendar. When I'm doing projections, I like to start with your fiscal year. So you can plug in January here, but you can also plug in other months, and you'll see how the spreadsheet later on kind of adjusts. But let's say we want to start this Taekwondo studio in 2018. That's it for the directions tab. It kind of takes this information and it puts it on the header and the footer areas of the remaining spreadsheet. So if you print it out, it looks nice. But aside from that, it points out two things here. You may notice as I was entering information, the colors of the sheet changed. It kind of going along with this color coding scheme. If it's light, you just kind of adjust as needed. If it's dark, it means you need to enter information for you to kind of well, populate the spreadsheet. Because what's going to happen is we're going to go through some of these tabs down here at the bottom. And once we get through 5 tabs, it will, in essence, create our cash flow statement, our income statement, a balance sheet, and a lot of other stuff that kind of takes the headaches out of putting all these numbers together in the right order. But let's see here. I'm going to put those back. And the other thing I want to point out here is that the spreadsheet is protected. If you want to modify some of the formulas here or just even some of the formats, you would need to go up to this review tab up here at the top, and the password, essentially click on review and unprotect. Well, in this case, this tab isn't protected, but let's go to the next one. Go to review, unprotect, and the password is just 1234. And now we can change and hopefully not mess up the formulas. But that's it for the directions tab, really. Your name, when you're starting, pretty straightforward, right? Well, the next tab is called the starting point tab. And for the existing businesses, this is going to be your balance sheet, if you will. So let's see, you know, ending year end, if you will. You see here we've got fixed assets. You know, that's kind of your balance sheet is assets minus liabilities equals owner's equity. And so a lot of times you have your long-term assets listed here. And then you'll have pretty much your current assets is really just cash on hand. Maybe you have some rent deposits. But what I do with businesses that are already established is I just kind of ask for a beginning balance sheet from when we're starting our projections. And I can take all those numbers and I can funnel them in here to start with. But a lot of times for startups, this is where you're kind of listing all your startup expenses. And so let's just take it from the top. Again, we're using Sean's TKD as an example. Do we need to buy any real estate or land? Hopefully not. Maybe we buy a building, but not in this case. Let's be honest, we're getting started. Maybe we want to buy the building later. Leaseholder improvements though. We found a space, but you know, we gotta kind of, let's say we need $30,000 in leaseholder improvements, and that's gonna be in the form of, let's say, mirrors, mat, you know, we need flooring. So let's say we need an office. So maybe the place we're looking at doesn't have a walled-in office. So we need office walls. Maybe we need some electrical. You know, these are all the tenant improvements that we're gonna have to come in and put into place before we can open our doors. In terms of equipment, yeah, we need some equipment. We need, like, let's say $10,000. I don't know. These are just purely fictitious numbers to show you how the spreadsheet works. But let's say punching bags. We need some cones. We need, you know, some nunchucks. I don't know how to spell nunchucks, and please forgive my spelling errors as we go. I always do that at the end to make sure everything's spelled right. But furnitures and fixtures, yeah, you know, we're gonna need to say, I don't know, $4,500 in tables and chairs for folks to sit, you know, while they're watching their kids play. You know, we need office furniture, things of that nature. I really encourage you to write down kind of what you're budgeting here in the notes column, because you'll often come back to this and go, what was that $4,500 for? You know, so as we go, using the notes column to help track is going to be really helpful. Let's say pre-opening salaries and wages. These are expenses in terms of salaries that we're going to have to pay before we even open our first open on day one. So let's say I'm gonna put a formula here, and I'm gonna say equals, we need 2 people times, let's say we need 80 hours or 2 weeks worth of training time, and the average cost per hour is $15 an hour. So we'll put that in the notes. So 2 trainers for 80 hours for let's say at average of $15 per hour. Prepaid insurance premiums, yeah, we're gonna need to have some insurance to sign that lease agreement. So let's just say $1,000 general liability. Inventory, yeah, we're gonna need, let's say, I don't know, $500. No, let's make it more, $1,000 in, let's say, uniforms, because you know when you sign up for Taekwondo, you usually get your initial gear as part of your trial offer. uniforms, and belts. All right. Legal and accounting fees, yeah, let's say it's going to cost us $1,000 to say LLC setup and lease review, because we want to have an attorney take a look at our lease. Rent deposits, you know, they're usually going to ask for first and last month's rent. Let's say, you know, it's $2,500, 2,500 times 2. Let's say first and last at 2,500, not 25,000, 2,500. Utility deposits, you know, everything's hooked up, but let's just say $500. Supplies, I don't know. Let's go with, we gotta buy some, let's see here, paper, brochures, I don't know, just things of that nature. But that's gonna run us like $250 tops. We're gonna run to Office Max or Staples or something like that. Advertising and promotion, you know, let's say we gotta, let's see, I don't know, I'm gonna do a formula here. I'm gonna say equals $2,000 for a website if we're having someone build it out for us, and maybe $1,000 for a grand opening. So let's see, 2K website and 1K grand opening with chamber, because that's all, you know, your grand opening is a really key time to introduce your business to the community, and vice versa. See how you can get involved with your community. Licenses and permits, you know, I ran a list of licenses and permits, and it's not going to run us too much besides just creating the entity. I'm going to say $250. Let's say $100 for city, and let's say $100 for DBA. I don't know. But you may run into, and I always say talk to the city to really get an idea of the costs associated with starting the business. You know, we're doing some tenant improvements up here, so maybe we have to, in order to get our certificate of occupancy, we have to do some sort of plans and have an architect come out. Again, these are fictitious numbers, but this is a place to put those numbers as you're kind of putting together your costs with starting the business. And you've got another bucket here for other initial startup costs. You know, this is what you can use if, you know, it doesn't fit into one of these buckets. You can even rename them. I don't really recommend that because they kind of tie into other areas of the spreadsheet. But taking those other initial startup costs, and one that often throws a lot of people in starting a business is, well, how much money do you need to start with to have in the bank? Let's say we have $20,000. And I'll just say initial cash deposit. All right, so what we've shown here is we've kind of gone through and said it's going to cost us $78,000, roughly $79,000 to start this Taekwondo business. Again, purely fictitious numbers, but you know, a starting point. Now, well, you have two other areas to consider. One, owner's equity. How much of this money are you putting in? Let's just say, you know, we're going to put in $75,000. You know, we've saved up, and this is really our dream. We've worked in the industry, which is a key thing to point out too. A lot of times that you're going to know the numbers a lot better when you come from the industry. But let's say, you know, we have this gap of $3,900. I don't know, and I'm just going to plug it in. I'm going to say, well, I won't get a loan. Let's say we're going to put it on our credit card, right? $3,900, and voila. If you are a starting business, this is essentially your beginning balance sheet. These are all your startup costs associated with starting the business, and important to keep track of, especially in year one, because you can amortize these costs too, some of which. So definitely work with your tax person, let them know you're starting a business, what you need to keep track of, etc. But from a budgeting standpoint, you know, we have a beginning balance sheet. This box down here is more for the existing businesses. If you have cash and accounts receivable, how to work those in, because those are definitely assets. But we have a starting point, and the next point, or the next step, is payroll. What I like about this spreadsheet is it kind of segments out payroll, because it's a very large expense for a lot of businesses outside of rent. And so we've kind of got, again, you can see these dark areas here that we have to fill in. You can plug in a compensation factor for yourself. Very important, because you got to pay your own bills. Let's say we have one owner. We want to make, I don't know, $25 an hour, and we plan to put in 40 hours of work. You'll see as you plug in these assumptions that it's going to multiply this times this and give you kind of some monthly wage costs. Then down below, it's also going to multiply your wages times, your appropriate, payroll tax rates. It includes Social Security, Medicare, FUTA, SUTA, but it does not include workers' compensation because that varies from business to business. So we're a Taekwondo studio, so, we're kicking, we're punching, someone's going to get hurt eventually. My guess is that might be kind of high. I don't know. I'm going to plug in 2%. But also here you can kind of change or add, I like to add rows here. Maybe instead of employee health insurance, we have, let's see, and again, here it is, it's protected. So again, each tab you kind of have to go unprotect, 1, 2, 3, 4. But maybe instead of employee health insurance, we have 2% for, we have someone doing our payroll, so they charge based on the wages. But going forward, continuing along with this, full-time employees, let's say we have one full-time person doing, $15 an hour, doing 40 hours a week. We have one part-time person doing, let's say, $12.50 an hour, doing, 25 hours a week. And again, sometimes what I like to do is actually insert rows here. You have to update the spreadsheet, but I like, instead of just full-time, part-time, I like to have the kind of the job categories or classifications. We have instructors versus masters, if you will. But for the most part, to kind of get a ballpark, we're looking at payroll expenses of about $9,000 a month. This is a big expense that we need to really hone in on and take a look at. But that's just, again, for payroll year 1. You can see it's only the first 12 months. The second payroll tab, 2B, kind of the spreadsheet works by, of course, everybody likes to see that hockey stick, right? You're just growing, making money, you're spending money, and it's continuously increasing. It's hard to imagine what's going to happen in outside of 12 months, much less 2 or 3 years. But if you do have those assumptions, you can use them here, and they give you kind of percentages to increase. I will usually zero a lot of these out in order to just focus on actual assumptions, but you can use the spreadsheet this way. But again, I usually tend to focus just on the first 12 months when I'm kind of determining feasibility. So you can use this, but I'm going to skip over it for now for the sake of time. It's pretty self-explanatory. But the next area is sales projections. Definitely one of the hardest for startup businesses. Again, why it's important to come from the industry, because the way this tab works is you kind of have 2 boxes here. I've highlighted one. This is essentially your menu of services or products if you're a product-based company. Let's say we're selling monthly TKD student enrollment. All right, and this is students, the number of students. Let's say we sell it for $120, but the cost of goods, there really isn't a cost of goods, if you will, because it's either us or our employees training it. But if there was something, and you could factor it in here, like that uniform we talked about, but since it's so minimal, I really wouldn't throw it in here. I would count for it later on in the expenses column. But so we're going to leave that blank. But we don't. So our margin basically is 100%. But let's say, in addition to doing, monthly, training, if you will, we also do belt tests, right? Students, and that cost. We charge $50 to every time you graduate from your yellow belt to from your white belt to your yellow belt, and so forth. But there is a cost associated with that. We have to buy the belt, right? So that's pretty direct. Let's say it's $3, very minimal, right? So we've got, if you will, our menu of services. And I'm just using this as a very basic example because you would have other things. I don't know, maybe you're doing birthday parties, maybe you have annual subscriptions. But the important thing here really is to categorize your revenue, because at the end of the day, all of these projections are just based on numbers. They're based on assumptions to get to the numbers. So we really need to look at our revenue streams and develop some solid assumptions that go behind them, because that's what any banker, anybody that's getting involved with your company, or you as a business owner need to really understand. So if those assumptions don't play out the way you see fit or the way you planned, you know how to adjust the business so that you can remain profitable. So let's just say, we're going to start out with 30 students a month. And I'm just going to, for the sake of example, I'm going to say we're going to add 5 students, let's see here, plus 5 students a month from now until December, right? We're starting in January, we're going to continuously add. Now, 2 things I would point out with this is, one, I would usually look for some sort of seasonality. Maybe there's a big spike in enrollments during the summer months because people are like, get these kids out of here. I need to give them something to do. There's longer hours in the sun is out longer. I don't know. But I'm not seeing any seasonality. I am, though, seeing at least some sort of like realistic kind of idea of like, okay, you're not going to just start out, boom, with like 150 students. You're going to gradually grow. And let's say that, on an average, we're going to have 20 students a month taking a belt test. That's going to be kind of our average. But again, these are just based on assumptions. And hopefully you come from the industry where you kind of have a good idea what those drivers are and what those assumptions are. But for this example, what this will do is, as you can see here, as you plug in menus of services here, it kind of populates down here. We've left product 3, 4, and 5 kind of open and all the way down to 6, but it will total all of your units sold, your total sales volume, your total cost of goods for that month, and your total margin. And so we're going to come back to that in the cash flow to see how it ties together. Again, 3B focuses on, years 2 and 3. For this particular spreadsheet, if you want, you could say we're going to grow at 10% a month, kind of like what we did with payroll. Payroll is going to grow by X%. You can make that 5%, and you can see these numbers drop in year 2. But it's an easy way. Again, I tend to really hone in on the assumptions behind that. And, if you have time, definitely take a look at it. And I've worked with clients that do know their plan 3 years from now. But as a startup, that's kind of hard. So I'm going to keep going to tab 4 is additional inputs. This is now what we're talking about is accounts receivable and accounts payable. Very important to your business is to know, well, do you offer terms? Most businesses I work with that are either service or retail are pretty much cash businesses. And so if you're a cash business, I would just make this 100% paid within 30 days because we're not offering any terms. But if you do offer terms, you can usually pull in QuickBooks, you can pull an aging of accounts receivable and aging of accounts payable to kind of discern, how many people actually pay of our total sales each month, how much are paid within the certain periods of time. And the same thing goes for accounts payable, and aging. But I'm just going to say for this example, we are a cash business. We don't offer any terms. And, so we get paid at the time at the front of the month or somewhere in the month that we deliver the service. Another good question I always ask clients is, well, what is your minimum cash balance that you want to have in the bank account at all times? Because not everything can be paid with a credit card. Some things you have to pay in cash, like your people. Cash advance on a credit card to cover payroll, this is going to be pretty costly. And so let's just say, I don't know, we're looking at payroll costs of $9,000. I'm going to go back to tab 4, and I'm just going to plug in, we would have $9,000 at minimum on hand. And what is our interest rate for our line of credit that we have? Is it 8, 9, 10%? What is, if we do put things on, if we do run out of cash and we need to put things on a credit card, what's that interest rate? Going down, this additional fixed asset purchases, I don't tend to mess with too much because typically when I do adjust things here, and you can, but there's a tab later on in the spreadsheet down here for depreciation, amortization. I end up having to kind of adjust that sometimes if we're looking for a loan to buy a large piece of a large asset like a building or something. But I'm going to skip that for now because a lot of times with our startup businesses, if you are looking for a loan, you're looking to start the business using the loan. And that's already been factored in. Like, for example, our credit card. It's also got some interesting, you can plug in your income tax here. They plug in pretty conservative numbers, at least 20%. And the amortization period of your startup costs over 3 years. You can extend that. You can do accelerated depending on your tax situation and your tax advisor. But this is at least depreciating it or amortizing it. over a period of 3 years. So some funny additional inputs to consider beyond just your payroll, your sales projections, and the last leg of the tour, your expenses. Just like our revenues, you know, we would expect some sort of seasonality. Same thing to some extent with the expense side of the equation. Advertising, I don't know, let's just say we have $150 that we're going to spend every month on advertising, you know, between, I don't know, let's say our email newsletter, maybe some Facebook ads or Google. It's pretty low, but I'm just using an example. Let's see what else. Contract labor not included in payroll. I don't know, let's say we have another $100 that we're paying for bookkeeping services because, well, we don't like bookkeeping. Insurance, yeah, we had to get insurance out, you know, in the beginning, which was what did we say insurance was? Insurance was $1,000 a year. So, you know, maybe that hits in, let's say January, or no, because we're starting it. Let's say we took it out in December. So $1,000 a year in December. Legal and professional services, well, definitely, you know, we got to pay our taxes. So maybe we hire a CPA or somebody to do our taxes. I don't know. And let's see what else. Licenses. Well, if we decided to be an S Corp or a LLC, we have to pay our minimum $800 a month in April or March each year, every renewal. We said that we had rent of $2,500 a month, so that's pretty constant. You know, it might change each year, but at least for the year, we have that pretty much constant. Utilities, the same thing. Let's say, I don't know, $150 a month for things like trash, security, I don't know, pest control. So you can see how you can start plugging in expenses, and some of them are going to be kind of regular, but some of them are going to be, you know, kind of ad hoc, like these ones we've thrown over here that kind of hit at different times of the year. You can already see, well, our expenses in March are very different from our expenses in April. And those are the kind of timing things you really want to worry about or know about, so that you don't run out of cash, because cash is king and cash flow is queen. And so that's what we're going to get to next. Again, like the other tabs in the spreadsheets for years 2 and 3, you can add incremental percent increases for different categories to kind of, again, project years 2 and 3. But at the end of the day, we have finished some preliminary financial projections for Sean's Taekwondo studio. And this is what I call the moneymaker or the money loser in some respects. And this is your cash flow spreadsheet, or yeah, your cash flow. So let's see here. Let's take it from the top. $20,000. This number comes from back in the starting point when we said we were going to have $20,000 to start with, right? The initial cash deposit, what was in the bank on day one. We said we sold $4,600 worth of services. That comes from our sales forecast year 1, which counted for 30 monthly students that we signed up that month. Woohoo! And 20 belt tests to graduate them from, let's say, white belt to yellow belt. So if we scroll down, you can see, you know, $4,600. Going back to the spreadsheet, and again, we said we were cash business, so we got that money the same month that we sold it. It wasn't like, oh, you can sign up and then you pay us next month. No, we get the money same time. So total cash coming into the business is $4,600. Started out with $20,000, brought in $4,600, right? Now let's look at the cash going out of the business. And that comes in a couple forms here. Cost of goods. Well, it costs us, in order to bring in some of that $4,600, it costs us $60 in belts for those 20 students. That's a cost associated. Our operating costs, $2,900. That came from, well, right here on the expense tab. We have $150 in marketing, $100 in our bookkeeper, rent, and utilities. So, that was you know, expensive. Ooh, payroll. We got $93.27 in payroll coming off of our payroll tab here, which was for the one owner, one full-time instructor, and one part-time instructor, plus payroll taxes. And again, this includes at least the 2% for, let's say, our payroll processing fees. So that's a pretty big expense for the month. And then loan payments. Oh, that's right. We put in the beginning, we said, we had $3,900 on a credit card at 7% for 5 years. Just using 5 years as your average payoff period. Hopefully, that's a good number. If it's shorter or longer, you can adjust it. But we're budgeting basically $77 on that credit card, and that is factored in here. So if we add all these up, what we're looking at is a total of $12,365 going out of the business. So simple math, $20,000 to begin with, brought in $4,600, sent out $12,000. We have a negative cash flow for that month of $7,765. We have an operating cash balance now, a little bit less than a beginning $20,000. Now we're at 12, but we didn't go below our minimum cash balance, which I believe we said was $9,000. So we're still okay. There's no line of credit, but you can see next month there's a line of credit. And and down here you can see line of credit balance. We can see this line of credit balance growing. I'll be darned, it does not stop. So what this is telling me is we aren't making enough money to cover our expenses. And at this point, now what we can start to do is going back through those assumptions. Let's say, payroll, well, we can't afford someone working full-time. We're going to have to work with just one part-time instructor. Okay, boom, made a quick change. Now we don't run out of money until the next month. So, and let's see here. Oh, okay, now what are we seeing? We tap out at a line of credit balance of $12,452 in August. So, okay, now does that mean necessarily if we go back and maybe we need to start out with more than $20,000 in the bank? Maybe we need let's add $13,000 to that original. We need $33,000. How does that now affect us? Okay, now we're doing okay. We have no line of credit balance, but our ending cash balance is going down. So now, okay, maybe we need to really hone in on our sales volume because it's going down until December. So maybe that's when it starts to pick up. But this is, in essence, how I start to look at businesses and their sustainability, looking at the marketing strategy, because it's kind of this chicken and an egg, if you will, to do you spend money on marketing, but by spending money, you're adding additional burden to cover. But looking at your business plan, this is only part of it. Aside from the financials, I would definitely say, your marketing strategy, where you're spending your time and money to make sure that people know about you. Because, well, what I'm showing here is that 30 students a month is not quite cutting it based on this particular service that we offer. But then there's a key question: what is the number that we need to hit? And then how long is it going to take us to get there? And there I want to point out one of these tabs down here further on, and I'll cover these. This is just your monthly income statement it will put together. This is a 3-year income statement. We're projecting to lose $30,000, $42,000, and $63,000. So again, going along that theme that we're not making enough money. And then your balance sheet, 3 years. This is saying we aren't balanced because, well, we made that change back here. Let me go ahead and update it. 13,000. That's got to come from somewhere. So let's just say we dipped further into our piggy bank and added the 13,000. So now we're balanced. But let me go back to so now we're balanced again. Okay, good job. We're still losing money, and you can see our equity is dwindling. But what I wanted to get back to is that question: is what is that magic number? What is that break even? And this is a key tab for any new business that's saying, okay, based on our gross margin, we pretty much have 100% gross margin, because the only cost of goods we really are running into every time we sell something is our belts in this example. But payroll and operating costs give us a total fixed cost of $120,000 a year. If we divide that by our margin, we're getting basically a yearly break even of $121,000. Now, if I just, I got to unprotect this. Review, unprotect, 1, 2, 3, 4. If I wanted to say, okay, let's see, monthly fees and bill tests. What I could do here is I could say, if if I go back to our sales, our sales projections, I can see that, well, 87% of our sales is coming from, well, student fees, and roughly 13% of our sales are coming from the belt test. So I can say, okay, if I wanted to kind of get an idea of how much I need to be selling, I can take my monthly break even. Let's see here. Actually, I'm going to do that over here. Let's see. Equals your monthly break even times 87%, because that's what is coming from our sales. And then equals, oops, hold on. I did multiply. Divided by 87%. Let me do this, 0.87. Let's see here. Hold on. Yeah. So monthly break even, 87% of, do my math all wrong. Okay, so equals 0.87 times 10,000, and then equals 0.13 times the monthly break. So I can get basically, okay, monthly break even, of which needs to come from these two categories. And then I can divide this by, our sales, we're selling at $120 a month to go to study. So this isn't dollars, but rather this is units. And so we need to be at, based on these projections, this divided by $20, or no, it's $50 a month. We need to be doing, just for sake, this kind of bothers me. Just make it general. We need to be, now I added a bunch of decimal points. We need to have 73 students a month and be doing on average, 26 belt tests. So that way we're at break even. And that's including paying or something. That's probably why it's very high. So then we kind of need to figure out, okay, where are we at now? How long would it take us to get to, at least 73 students enrolled on a monthly basis, so that we can afford our rent, to pay ourselves, to market the business, etc. And so this is, you've got other financial ratios and diagnostic tools and cost of goods calculator, a lot of other stuff. But really, at the end of the day, what I focus on and really look hard at is the break even. And so if you want to take a look at your break even, I also want to share with you how to sign up with us here at lavernesbdc.org. So we can kind of go through this spreadsheet with you, because we do this all day, every day. And we want to help take some of the pain out of developing these projections, but also make it a little easier for you. We see a lot of businesses, we want to help impart some of that onto your business to be successful. So you can click on consulting and click apply now. And what this will do is it's going to ask you your name, your address, or not your, you create a little account, and it'll ask you about, your business, where you're located, what you need help with, and when you click submit, we get an email that says, hey, Sean has signed up for help with X, Y, and Z, and we will email you back the next available date and time to sit down and chat with me or another consultant to discuss your business and its needs, because maybe it's not financial projections, maybe it's lending, maybe it's marketing. We're here to help. So with that, I want to thank you very much for your time, and I guess I'll turn it over now to Fidel or David to see if we have any questions as we're wrapping up this webinar.